So the Federal Reserve just cut interest rates for the third time this year. And if you've been waiting to buy a home or waiting to make a move, you probably had one very reasonable thought. Great, mortgage rates are about to drop, so let me save you some heartache, because that is not what happened, and it's not what's going to happen. So today I want to walk you through why the Fed cutting rates has almost nothing to do with your mortgage rate, what the Fed chair actually admitted about the housing market that most people missed, and what this means if you're thinking about buying, selling, or relocating in the Las Vegas luxury market. Here's the thing almost nobody explains correctly. When the Fed cuts rates, it is cutting something called the federal funds rate. That's the rate banks charge each other overnight. It's not your mortgage rate. Your 30-year mortgage rate is tied much more closely to the 10-year treasury yield and to what investors believe about inflation over the long run. So we can get into a situation, and we are in exactly the situation right now where the Fed cuts and mortgage rates actually tick up. That's not a glitch. This is the bond market reacting to what the Fed chair says about the future, not what he did today. And that's exactly what played out. The Fed cut a quarter point, but the chair made it very clear that more cuts are not guaranteed because inflation is still running near 3% while the job market softens. The market heard that and repriced. So if you're told that a rate cut means cheaper mortgages, now you know why your lender's not calling you with good news. If you're getting value out of this, do me a favor, hit the like button and subscribe, and then comment below so you keep getting the real story on this market instead of the headline version. It genuinely helps me and this channel grow. Now here's the part that I actually want you to hear, because this is a rare moment of honesty. When the Fed chair was asked about housing, he did not promise relief. He said the housing market faces some really significant challenges that a rate cut simply cannot solve. Powell said the same thing. He pointed to two things. First, a structural housing shortage. We have not built enough housing in this country for a long time, and the Fed can raise and lower rates all day, but it does not have the tools to build homes. Second, the lock effect. Millions of people refinanced in historically low mortgage rates during the pandemic, and moving means giving that up. So a lot of inventory is simply frozen. It's stuck. So let's translate what that means for you here in the Valley. If your entire strategy is to sit and wait for the Fed to rescue affordability, then you're betting on something the Fed itself just told you it can't deliver. The forecast backs that up. The Mortgage Bankers Association expects average rates near 6.4% through next year. Fannie Mae sees them drifting towards roughly 6% by the third quarter. Those are not the dramatic drops that people were hoping for. They're a slow grind. But here's what it gets interesting, right? And this is especially true in the luxury and the relocation market. That locked-in effect that I mentioned, it barely touches the buyer who's relocating from California with a lot of equity, or the move-up buyer who's not stretching to the last dollar of their mortgage. So if you're coming from a coastal market and rolling substantial equity into your next home, or you're buying in a range where financing is a tool and not the lifeline, the rate environment's far less of an obstacle than the headlines suggest. The people who are frozen are the ones with a 3% mortgage on a starter home. That's not who's moving into Summerlin, the McDonald Highland area, the Ridges, Dragon's Ridge, things like that. First time stopping the Fed. Even the professionals who do this for a living are divided, and the chair told you directly that housing is not a problem that he can fix with rate policy. Second, focus on the things that are real. The inventory in the segments that you care about, pricing on the specific home that you want, and your own financial position. In a luxury market, the right home at the right price matters far more than shaving an eighth of a point off a rate that you may refi in 2 years anyway. And third, if you're relocating, understand that the equity that you're bringing changes the entire math. So you're playing a different game than the average buyer, and you should be advised like that. So this is the honest version of what just happened, and why the rate cut you keep hearing about is not the win it sounds like. So if you're thinking about a move into the Las Vegas luxury market, or you're relocating and you want a straight read on what the numbers actually mean for your situation, reach out. Never any pressure, no pitch, just a real conversation and give you the input that I can give you and that value as an agent to help you. Anyway, I'll see you guys in the next video.